On this episode of Through the Pines, we will chat all the hot financial planning topics for summer 2026, from AI to energy inflation, Fed policy, economy resilience, and market outlook, and more. Welcome to a financial planning podcast with down-to-earth vibe. Sasquatch listens while sneaking into World Cup stadiums to catch the magic matches. This is Through the Pines. Our advisors for this episode, we welcome back Rex.m.baxter and Brandyn Smith from planwithbaxter.com. They are the 23, 24, 25, and even this year's 2026 Forbes Best In-State Wealth Management Teams for Utah. They're the advisor hub, fastest growing advisors to watch under $1 billion, and the receivers of the Ameriprise Client Experience Awards. You should listen to them because they know what they're talking about. Rex Baxter and Brandyn Smith with planwithbaxter.com. If you would like to learn more after the podcast, please visit planwithbaxter. It's BAXTER.com. Let's dive into some of the hot financial planning topics in June 2026. So yes, I just Googled, or I didn't just Google, I used AI to be like, hey, what's everyone talking about? Let's address some of these issues now, because I feel like, especially with AI, which is the first one we'll jump into, a lot has changed in the last 6 months. We did a full podcast on AI and how it affects your financial planning or doesn't, and what humans can do. But it feels like it's moving very rapidly, this AI thing. And so what does it look like in June, July of 2026 versus what it looked like maybe in the fall of last year? Rex, any thoughts, any new changes as far as AI and financial planning in your specific business?
Well, yeah, first let me say that I'm pretty sure I'm excited to be on this podcast.
I hope so. Yeah.
So, this one should be interesting. I'm not sure
Yeah.
we've had a lot of prep on this one, so
Right.
So this should be fun. I'm excited.
I'm gonna hit you with the
I'm
big
excited.
stuff. Yeah.
So changes in AI in our specific industry. We're starting to see AI being talked about a lot more,
Yeah.
and utilized, whether it's, in today's current environment. You hear a lot about ChatGPT, you hear a lot about Copilot, you hear a lot about Claude and Anthropic, things like that, as far as the different, pieces of AI, if you will. And so in our industry, we're seeing a little bit more of usage on using AI to evaluate, tax returns, evaluate estate documents, evaluate statements, things like that, in order to assist with financial planning, to kind of pick out and save time efficiencies, to find opportunities to either reduce taxes or make it more efficient, or possible gaps in language in estate planning, things along those lines. And then in addition, we're using it more in the back office of our firms in order to service clients better, to add to security, different ways like that. So we're starting to see it infiltrate the industry a lot more, and those that are able to adopt quicker tend to be those that are growing a little bit faster and able to wrap it into their practices. And those that are a little bit slower, I think we're just barely seeing the slowdown of maybe some of those advisors. But I think we're just on the front edge of all this.
Yeah, Brandyn?
Yeah, I think it is still early. One thing that we actually are doing now that we weren't when we recorded the podcast is we actually have AI transcription. And so as we're meeting with clients, and it's interesting, right? As we're meeting with clients, we're saying, hey, is it all right if we transcribe and have these notes done?
Oh, that's way nice. Yeah.
Oh, it's so nice.
And then, not just for you to review, but to be like, well, this is what you said.
Right.
Well, it helps create a follow-up email to us,
Yeah.
right? That says, hey, look, here's a summary of the meeting, and here's
Yeah.
some things that we wanted you to do and some things that we're going to do, and different pieces like that. And so it just kind of memorializes those meetings really, really well.
And I like it as an advisor because we used to meet with clients, and then after we'd sit there and type up our notes and say, oh, this is what we did, and this is what we talked about, and those were good. But I find my AI notes are far more comprehensive, right? Because the AI will transcribe the whole meeting, and then it'll put it in like a nice bullet pointed, like a really nice presentation of all the things we talked about. And then we still have to review that and make sure it's accurate, right? Because sometimes transcription, I had a funny story actually on that. I had a meeting with actually a group of people, and we all hung up, and then I went to go do the transcription, and someone had stayed on, and the phone had, like, the phone or something with their device had captured an entire conversation with someone else. Anyway, it was funny. But we review our notes and make sure, hey, are all these, is this really what we talked about in the meeting? Is that accurate? Make sure it's good. But then the notes are just so much more thorough. And what's interesting is we're bringing that up with clients saying, hey, is that all right if we transcribe? So often people are like, oh yeah, and we're using that in the doctor's office, or we're using that in this, and I'm seeing this used more and more throughout just every, like, it's very like, it's not uncommon to talk to someone and them say, oh yeah, I'm using AI for this, and it's creating a lot of efficiencies for my job. And I think that's the exciting part, right? Because that's where profitability and growth can come.
Yeah, definitely not 100% of clients are adopting it yet, though. We still have a small handful that that are nervous and hesitant, and they're like, yeah, I'm not sure where this goes. Yeah. And I'm not sure, is it capturing the sound of my voice? Can that be recovered and used against me? And those are the fears that are out there, and I think dispelling some of those fears is good, and credence to the fears that are legitimate are good also to talk through that. So
the opposite of that would be the person that comes to the meeting and says, well, I'm just going to use Claude to run all of my financials, and I don't need a human being anymore. Rex, we talked about this a little bit on the specific AI podcast, but what do humans still today in summer of 26 have to provide as far as financial planning over AI?
Yeah, we still see some of the AI giving us wrong information, right? And so we still will ask a question just to test out different AI pieces and see what answers come back, and it's not always the same answer. And so
and it's wrong, and then you tell it, no, that's wrong. And oh yes, yeah, that's right. Sorry about that. Here's the right answer.
I like that it apologizes.
It's like whoops. For the love. But what I do like about AI is I was literally yesterday, I'm trying to refinish my trailer roof, and like the rain has not been cooperating, right? Like it was supposed to be sunny, and anyway, and so I had to like take a pause, and it was gonna rain. I'm like, oh man, the rain's gonna get it dirty, and then I'm gonna have to wash the whole thing off. I'm like, maybe I'll just tarp it. I'll just throw a tarp over everything, right? And then I asked AI, I'm like, should I just throw a tarp? And it's like, well, probably shouldn't throw a tarp on, because that can trap moisture, because the first coat is still kind of curing a little bit 24 hours later, and it might stick to it and peel some off. I'm like, oh no, that's a good point, right? And I think that's the benefit of AI is being able, because can you trust everything it says? Absolutely not. But if it can, you compare that with a human brain, not compare, you can pair that with a human brain and say, oh yeah, that is correct rationale. Oh yeah, that is correct. And it can provide idea generation. It can provide meeting summarization. It can provide like those, then it can be really helpful. The danger is though, when people just blindly start trusting AI, at least right now, it's not accurate enough to just blindly trust. And so do we ever get to a point where we can blindly trust? Maybe, and that'll be an interesting day. But even then, for investments, I've thought about this a lot. The last thing you want is the entire investing world to groupthink together. That will create a massive run and crash so fast in the investing world, right? You can't have, like, groupthink is incredibly dangerous, right? The benefit of an open and free market is a lot of different opinions and a lot of different analysts. I tell people all the time, right? Like, they're like, well, what's everyone saying, right? Is the market going to crash? And I tell them, like, that's dangerous. Like the second you're talking to everybody and everyone's like, the market's going up, that's when you know you got a red flag, right? That's euphoria. That's when it all crashes. What happens if everybody uses the same AI algorithm to choose their investment choices? That's not a good thing, right? You need that diversity of thought within the investment world. Otherwise, bad things happen. And so we'll see.
It's interesting because you can pose, the same question with two different slants. Right. And so you could sit there and somebody could pose the question as to, how can, this issue in the Straits of Hormuz impact oil prices? And do you think that will negatively impact my portfolio? And just phrasing it that slightly, asking, will it negatively impact my portfolio? Well, right now guides most of them to say, oh yes, it could, and sometimes it even comes back with certainty that it will impact your portfolio negatively, and here's the different ways, kinds of things. Somebody else may phrase it and say, hey, is this going to create some opportunities in oil and energy companies and because of that slight slant, all of a sudden now it's coming back with a positive slant. Absolutely. It just is starting to reaffirm the slant.
So the way you
you're
ask
asking
matters.
the question is significantly.
Well, and the problem is, just like Rex said, AI is trying to appease you. It's trying to give you what you want, which is just what
Why
my
I
AI
like it.
is so polite.
Yeah.
Because I'm so polite when I type in. I'm typing. I'm like, will you please do this? I really appreciate it, and I have good punctuation. I'm always using please and thank you, and so it always comes back, and it's like, oh, why, thank you, Rex.
Yeah.
Yeah. So
You've got this.
But
That's so funny.
But the problem beyond like all the hypotheticals of life of like looking in a mirror, like the danger is AI is going to tell you what you want to hear. And that is one of the most important jobs we have as an advisor that we do frequently is tell people things they don't want to hear, right? And we try to do it as politely as possible, but that's why people hire us. I've had plenty of clients tell me, no, Brandon, like the reason, like don't feel bad. This is why I hired you, right? I want to hear if I'm thinking about this wrong.
Yeah.
And AI is going the opposite direction, which is incredibly dangerous. If you've got a friend that just tells you everything you want to hear, you're never going to progress in life, right? Because usually the progress comes from understanding hard truths, right? And that's where us as advisors, right, we can really help people is say, no, actually, we need to rethink this thought.
That is a very philosophical and deep point and very true point, Brandon.
And could be really dangerous in a volatile market downturn.
Yeah.
Right? Because if you're nervous and you're saying, oh my gosh, and you type into AI, this looks bad. Is this really going to...
Could this go to zero?
Right.
It's going to shoot back and say, yeah, it
all
could go
the
to zero.
reasons it could, right? And all the reasons you should probably sell versus a more steadied hand that's telling you things you don't want to hear, but that you need to hear.
Yeah. Interesting take I saw on AI was a financial investor who was on a program the other day, Rex, and he said, well, something to think about is I've got all of my employees are running AI, but they're currently on $1,500 laptops or personal computers, and it's not enough. And so I've got to have more. I've got now my entire business is investing in $4,500 laptops for everyone. And he said, it's not just to run this agentic AI. And now it's not just my business, it's going to be every business. And so on the flip side of that, and on an investing side of things, that's interesting.
Yeah. I mean, it really has a lot of tangents and tributary impacts across all the different industries.
Yeah.
Right. Whether it's in hardware, computer hardware, which is what you're referring to, right? Versus, it may be newsletters that somebody's going to sign up for more newsletters to read about it. It may come out to be, that all of a sudden the coffee shop is using more AI in order to learn how to market and do a better job of marketing to itself.
Yeah.
And so it really is going to have its fingers into all the different areas in one way or another is my anticipation.
And we're seeing business spending ramp up right now.
Yeah.
And which is kind of a cool thing to see that, and also see, corporate debt relative to free cash flow is still very healthy, right? And so, but why are corporations feeling comfortable spending some of this cash they have on the sidelines? Usually it's opportunity.
Okay, so AI did come up with this question on the summer 2026 IPO wave. The angle it suggested for the podcast is AI infrastructure still the biggest tailwind, or are valuations stretched? I don't know what English that for me, Rex. What does that mean?
That's a great question. So, AI, they're saying in the markets that AI has driven the markets up to their recent highs. And I think that can be witnessed by what we call how narrow the S&P 500 is, meaning that there's 7 or 8 companies that have been driving, that have accounted for roughly 80% of the return of the market.
Yeah.
And so that's what it means. Has it provided a tailwind? And it absolutely has provided the tailwind to drive the markets up to this point. And so the question becomes valuations. Are valuations stretched, meaning are AI companies overpriced? And the beautiful thing about the market is it does a fantastic job of pricing stocks today based on perceived future potential, is basically what it does, right? And so, according to where they're priced today, are they stretched? Well, apparently not, because that's where they're priced. And they're priced on that future potential. Now, if the masses believe that future potential is lessened than what it's priced in for, then you're going to see those prices come down. If those eventualities start to come to fruition, and the companies start to hit those markers. I think there was a company today that reported their earnings and jumped up 12% in the AI world today, and because they knocked their numbers out of the park. And so not only did they justify their current valuation, but because they're exceeding the projections, they're driving evaluations even higher.
Yeah.
So do I feel like they're stretched? Who knows? I can't predict the future. I can't, nobody can do. AI can't predict the future. That's one thing that people need to learn is AI is using past data
Correct.
and trends and different things like that to help you form an opinion of what may happen, but it's going to use not only your biases, but the biases of wherever it's gathering the data to project that trend.
Which is interesting, and another subject on here, but we didn't. It's one down, so I haven't get to it yet. But was the Fed did mention we always use past data, and the new Fed chair is thinking, hey, how do we live in the now instead of just going off of 3 months ago situation?
Yeah, which is interesting. I mean, he's a very smart individual, and I've been impressed by him so far. But one of his comments was that I want to get back more towards the Greenspan era, to where we're not pushing out as much information about where we're thinking on interest rates, because we don't want that to be controlling and influencing the market. And so he may, in the background, be using AI to help him discern the data that's coming out, but it's still historical data.
Yeah.
And so it's still going to be that way, but it's going to be an interesting time period to see if he sticks to that, and see if he's not as transparent on the future rates, or if he is.
Yeah.
So.
Okay, interesting. The next subject here that, of course, AI came up with for us. Hot topics 2026, financial planning. The Middle East conflict, obviously, energy shocks and inflation pressures, ongoing tensions, obviously the Strait of Hormuz and the oil that's coming in, that was stuck there for weeks or months. I don't know if it was months, but maybe it was months.
Yeah.
And now, is it flowing? What does this do? Are we feeling any pressure when it comes to, personal financial decisions? Rex, how do the geopolitics reshape your portfolios when it comes to this?
Yeah, so we look at it to see if we think it's a short-term issue or a long-term issue, right? And we're definitely long-term investors. That tries not to look at things in too short of windows. The issue in Iran and the oil and the Straits of Hormuz have been interesting, because it definitely caused oil prices to jump from roughly the mid 70s per barrel of oil up to 120, 130, 140 dollars per barrel of oil. And then it's come back down to about 79 over that time period. So we've had a big spike and a fairly large decline again. And so had it stayed, I think it did impact people. You saw gas prices go, up to, the mid $4 range for average across the country. You saw it in some states reach $6 or $7 per gallon.
Oh, I fed the machine in California on my California trip. I couldn't believe how much.
I think I paid $7.25 was my top rate in California when I was there.
So because my vehicle, I was like, at one point I filled up when the gas was really low a while ago, and I was like, oh my God, I'm in the $60 range for a full tank. And then I go this last trip to SoCal, and I was like $140. I'm like, that is a swing and a half, man.
Yeah. So it's hard to say that doesn't impact people's decisions.
100%.
Right?
Yeah.
I definitely think it does impact their decisions and their traveling and where they may choose to vacation. However, because it's fairly short in nature and it hasn't lasted longer yet, people are still in a really healthy financial position. And so I don't feel like it's changed their overall financial picture or their overall financial buying decisions at this point yet. But if oil was to stay elevated for a prolonged period of time, I believe it absolutely probably would, impact their decisions and impact the economy at large.
And oil's hard because if oil stays elevated, not only does that kind of hurt wallets and the ability for consumers to spend, elsewhere, but it also keeps inflation a little bit higher. And if inflation stays a little bit stickier, then the Fed is saying, you know what, as long as the economy's still running good, we're not going to lower interest rates, try and burn off more of this inflation. Well, if the Fed doesn't lower interest rates, well, then the markets have to borrow higher interest rate loans, which kind of slows them down a little bit. And so there's interesting. Couple weeks ago, we saw the jobs report come out, and the jobs report was unexpectedly good, right? Really, really good. What did the stock market do that day? Right, dropped like significantly. And people call it, we're in the good news is bad news thing, meaning that, hey, we have great, really strong jobs. You would think people would say that's great news. But the problem is markets are like, well, great. Now the Fed is going to look at the strong jobs and say, we don't need to lower interest rates. And so now we're going to be stuck with these higher interest rates, and that's not great for, profitability long term. And so we're kind of in an interesting dynamic with all of that. And I agree with Rex on this, that this more likely than not is a short term, issue. And with corporations being as resilient as they are with their debt to income, consumers' debt to income ratios, believe it or not, despite what you might hear on the news, consumers are actually in a pretty good spot. When you look at the Federal Reserve debt obligation ratio, which is arguably one of the best graphs and ratios to watch, right? Because it includes rents, mortgages, auto loans, student debt, consumer debt. I mean, all of that is wrapped into that relative to income. People are in a pretty good spot. Now, there is a segment, right, specifically younger people with high rents and lower incomes that are really struggling. But the consumer as a whole is actually in a pretty good spot. And so, are we worried about this, tumbling into something really deep? Probably not, right? There's always the chance of a recession. And that's why portfolios always need to be prepared, right, to weather through a deep recession. So that you're looking at how much you're pulling out of portfolios over the next 5-10 years, right? But high level, I mean, I think we're feeling pretty comfortable.
Yeah.
Side note, I went back to school in my 30s and took out some student loans, and I'm now in my early 50s, and my last payment to my student loan will be this month. So it'll be July.
Oh, big day, celebration day.
Big day. So I did have the Federal Reserve policy in the rates and what's going on with that, Rex. But AI kicked these out. It said Fed held the federal runs rate at 3.5. Is that right? To 3.75.
Yeah, that's right.
In mid-June. Under the new chair, Kevin Warren, who had his first meeting and everything. So projections showing possible hikes in 2026 due to the elevated core PCE forecasts that were revised up significantly. So no near-term cuts expected. Focus on balancing resilient growth with persistent inflation. So, what does this do to portfolios? And I guess the answer, and I was kind of pre-predicting what you guys would say is, well, we plan for long-term anyway, so I don't really know. This really shouldn't like impact you immediately.
For those that are listening, we might have repetitive themes.
Yeah, well, I'm starting to learn, a few from you guys. So,
good.
Yeah,
It's
so
good.
if Warsh, say, and the next time he meets does something with the interest rates, do you guys get phone calls every time the Fed comes out and makes changes, or how does it
Not
work?
really.
No?
Not
Okay.
I mean,
for
we
most
get
of our clients are pretty good.
right. We follow emails and we're following the policies, but I mean, let's talk about that, right? So let's talk about knee-jerk reactions, because sometimes people love them. It gives them something to do, right, and feel maybe in control when we can't control inflation or interest rates. Like I personally, right, can't control inflation, interest rates, markets, and so you want to jump into a knee-jerk reaction. Then what, right? Like what? Like inflation's going to be a little bit high. So what? Like what are you going to do, right? For me, it's, well, let's look at your overall portfolio and maybe we lean into inflation happy assets like equities and
Happy assets.
Right?
I love that.
This is a technical term in case anybody
Happy
listening is
assets are a
wondering.
thing.
Sorry
though.
for lack of better thoughts. No, but like really, right? You should be.
Yeah.
But that's not something that's new, right?
Yeah.
Like we're reviewing that with clients already. We've already inflation, whether it's at 2.5% or 3%, we should be adjusting our overall allocations, both in the investment world and our personal lives, such that inflation isn't going to hurt us too bad, right? Who does inflation hurt? People holding cash or promissory notes of cash, i.e. CDs or bonds or things like that, right? And trust me, Rex and I feel the pain of holding CDs and bonds, right? Do we hold CDs and bonds for clients? Absolutely, right? Because that helps provide some safety and protection from deep downturns. But we also recognize there's a cost to that. And that cost has already been weighed and measured, and we understand that we can't predict future downturns, right? And so the trick has to be, and I'm always talking to people about this, like, well, you got to kind of watch it at this point. Like, watch for what, right? Like, are you watching for the market to drop 10%? And then what? Right? If the market drops 10%, are you selling? Are you getting out?
Selling all of it.
Of course not, right? Because the market will drop, I think the average is 14.1% each year on average, right? It drops 14%. So are you going to wait till it goes 15%?
At some point, and then recovers.
Right. At some point during the year and recovers, and it usually ends up positive, right? So what are you going to do? Wait for it to drop 20%? Because that happens sometimes. And you sell right when it hits. Like, it's a losing strategy. Over and over and over again, it's a losing strategy to try and knee-jerk and react, because you can't predict the future. And so the answer is always, and I always laugh because it's the same answer, it's always, hey, try and position your portfolio such that you're going to take advantage of the more likely scenario, good markets and things we've always witnessed, but then be prepared for the deep recessions that will eventually come, right? And have enough set aside to get through that if you need.
That being said, right, I am seeing two things out there with clients and things like that, and especially prospective clients that are bringing in statements and things like that, is I'm seeing that a lot of them, because we've had 3 really strong market years the last 3 years. Yeah. We had a downturn in 22, and then 23 was really strong, 24 was strong, 25 was strong. 26 has been strong so far, very resilient. And so a lot of the portfolios have taken on a lot more risk over that time period because of one of two things. Either they haven't rebalanced their portfolio back to a normal risk level that they're comfortable with, or they've gotten a little extra comfortable with AI and the outperformance, and they've added to their tech and they've added to different areas to where I'm seeing that risk level of an average portfolio increase. And I think that's where the danger comes in.
Oh, yeah, interesting.
Right, is I think these are the times where you need to make sure that you go back to your core values and your core risk level, and you're rebalancing back to that.
Are we getting a little overconfident?
I think people are starting to get there a little bit. And so...
But that's the antithesis of knee-jerk, right? That is our regular reviews, our regular rebalances, right? Our regular meeting and saying, hey, where are we at? Do we need to rebalance?
What we're doing is the antithesis of knee-jerk.
Right.
I'm saying the prospective clients that I'm seeing are doing the knee-jerk by taking on more risk and letting the portfolio run.
Sure. Yeah.
Right?
No, yeah.
And so I think that's the difference between having advisors that are very focused on the risk of the portfolios, the portfolio construction, rebalancing regularly, things like that, as opposed to falling into that same age-old trap of, it's different this time.
Right.
And therefore I'm going to take on more risk and let the portfolios run.
Right.
And so that's one of the big things that I'm seeing out there. The other's on the bond side, right? Is Fed President Warsh came out and even though he's not talking about kind of trying to project out where future rates are, a lot of the other Fed presidents still are talking about that. And so the majority of them are anticipating a rate increase by the end of the year, and that's what's getting put out into the market right now. That's what's getting priced in is one Fed rate increase before
investors
the end of the year.
Respond to that.
And that's what drove, so that happened around the same time as the jobs report. Right. And so you're seeing the jobs report really strong. You're seeing inflation being a little bit higher, and therefore you're seeing the Fed come in and say, hey, we may raise rates instead of lowering them, which causes fear for some people and causes them, oh boy, maybe that means higher inflation, maybe it means a recession, maybe it means all these other things. And so, they try and knee-jerk, if you will, to that reaction. And that could impact their bond portfolios. It could impact different areas of the market. And so again, we may have a slightly different bend. We may go like on our bond portfolio from if we feel like rates are going down, we may have an average duration of 7 or 6 or some duration target. Whereas if we think rates are going up, we may have a little lower duration of maybe 3, 4, or 5, right? And so we may tweak at the edges a little bit on the portfolio for things like that. But that's the other thing I'm seeing is kind of that knee jerk on both sides, the equity and the fixed income sides of the portfolio.
Tweak on the edges. I'm going to get that as a shirt.
Tweak the edges.
Tweak on the. It's my portfolio, folks. That's what we're talking about here. Very good.
I didn't say twerk.
Yeah, or that. Yeah, or the twerk on the edges. No, tweak on the edges. So then the other subject the AA come up with to talk about for hot subjects in summer 2026 is just the U.S. economy and resilience amid volatility overall. So says Q1 26 GDP is at 2.1 annualized, strong personal income consumption, corporate earnings beating forecasts, and the S&P growth revised sharply higher. Labor market stable, but cooling affordability issues, of course. And there was a big vote, non-vote on that last night as far as housing goes. Healthcare, energy remain voter concerns ahead of the midterms coming up here at the end of the summer, early fall. Mid-year outlook. So J.P. Morgan, Morgan Stanley, Goldman remain constructive on U.S. growth, driven by AI and fiscal tailwinds. So the angle here would be, are we soft landing? Do we have stagflation? Dissecting the dual economy. What's going on here, Rex?
Well, that was a mouthful.
It was.
That was a mouthful. So,
yep. I feel like those financial news shows, and they just spit all this stuff out, and then they go to their guest, and their guest is like, I don't even know where to start.
Like, I've got deer in the headlights. I'm not even sure which one of those to attack first.
Right.
So, I think that we've seen just a little bump up in inflation, and I don't think we're headed towards stagflation. I don't think we're headed towards that, is my opinion. Okay. Again, we're kind of predicting that.
Go ahead and write that down.
Bit,
Rex
right?
said, yeah.
I do think that, we worry about, narrow. Are we on kind of talking about the narrow leadership and things like that of the market as well, right? And that's always a concern when we're looking at markets and market returns, is when you have narrow leadership in the market. So again, that comes back to 7 companies generating 80% of the return of the S&P.
Hasn't that been the case over the last
2 years, 3 years?
A while.
Yeah.
Okay.
Yeah, it's kind of been the AI trade, right? The Magnificent Seven, or whatever they were calling them, right? Yeah. And so that is a concern.
And those have broken up, but then it's kind of been taken over by a couple more.
Yeah, it's kind of broadened out a little bit. We do have a lot of companies that are fairly attractively priced inside of the S&P and inside of the markets. And so that, if those start to find some additional valuation and start to go up, then that could provide a broader leadership and a broader market, which is much healthier long-term market, would be a broader piece. Do I think that that's going to happen? I don't know. The AI trade has a lot in there, and so it still has a lot of momentum, a lot of emotion. It feels like it's taken over the excitement of cryptocurrency of the previous 8 years or so, that more of that is now migrated into AI talk and things like that. There's still crypto, that's getting talked about a fair amount on that side, but it's interesting.
Okay. Very good. What about stock market outlook? S&P 500 targets to end the 26. Goldman thinks it's going higher. Optimists see 8,000 with earnings up to 12 to 25% growth. In the
that's been revised.
That's been revised.
It's been revised up to that. Yeah. They were quite a bit lower earlier in the year. And it's funny, most economists do this. Right. Most market strategists do this. They'll start the year at some rational
almost
level.
Almost statistic normal.
Yeah, to where, we think we'll be 7 to 10 or whatever it is. And then as the year goes on, they start adjusting whichever direction the market's going.
Right.
So they
must be
more
really
and more
good
accurate.
at predicting.
So,
I mean, we just got done with Q1 earnings release, right? And companies are up. Their earnings are over 28% higher on average in the S&P 500 over the last year, right? So companies are earning 28% more today than they were a year ago. And people really aren't talking about that that much, which is crazy, right? I mean, that should be the banner headline,
Yep.
right? Like that should be like, holy cow, people are making money. Why are they making money? I don't know, buying new computers for employees. There's there's a lot of really, really good things going on. And people, I don't know,
but there's so much noise out there,
right,
between what's happening with the U.S. and Iran, between
Yep.
the political environment, the midterm elections, the current presidency. There's so much noise out there.
That makes the headlines.
One makes the headlines, but two really is hurting the consumer sentiment right now.
Yeah.
And so when you look at the consumer sentiment,
it's horrible.
It's horrible. People feel terrible about the economy on average.
Yep.
They feel terrible about the market outlook on average. And so, regardless of how good the numbers are looking, the people, when you actually ask them, well, how are you feeling about things? And they're like, oh, I'm really stressed.
Well, that's interesting. So, yes. And it's kind of for a couple things. One, if you ask someone personally, has your financial position improved or decreased in the last year? Usually they say, well, I'm okay. But in general,
right, it's bad.
But everybody else is bad.
Yeah, everybody else is bad. So there's that. But also, when sentiment is down as a whole, and do you get? But the numbers come out and they're good numbers, and people just don't believe them.
Right.
They don't believe them. And then do you get calls, Rex, because sentiment is bad? They're like, I think we need to make some changes here, and there's not even paying attention to the numbers.
Yeah, we get calls not necessarily because sentiment is bad, but it's how they're feeling.
Yeah.
Right?
Their personal sentiment.
Yeah, their personal sentiment. And so they're feeling stressed and anxious. I guess anxious is a better word, And so that anxiousness is what spurs the calls, because then they're concerned, they're emotional about it. They want to see activity, even though activity may not be necessary. They want to see something happen to feel like, okay, I'm taking a proactive step. When sometimes the best step is to hold the course.
Yeah.
So,
but from an investing standpoint, I mean, I love this, right? We've got a sound economic engine. Earnings are doing really, really well, right? The fundamentals of the economy, I mean, strong jobs, really good earnings, like companies are making a lot of money. Consumer, stability as far as debt to income is in a good place. Like we've got a really sound economic engine, and we have a bunch of really nervous people. Like that's a win-win, right? I mean, you want that's textbook investing. Is you want to invest, be greedy when everyone else is fearful, be fearful when everyone else is greedy, right? Buy when there's blood in the streets. Like all these age-old investing themes, which are usually very accurate. I mean, this is a win, right? We've got really strong economy and really negative sentiment. I mean, that's a great thing. What's funny about that is we can have this built into like the perfect, storm, which is what it looks like it is. And then you can be slapped with some news that we didn't see coming, right? Like even though it looks like the future is going to be really bright and we're going to continue to see some really good returns at least for another year or two, we could have some crazy thing pop up, right? And you never know when the next huge recession just comes out of nowhere, right? And so again, it's almost comical. It just gets back to the age old. We've got to make sure that we've prepared for our future distributions. We've set aside enough safe money for what we need, and then we're positioned to try and take advantage as much as we can of any growth opportunities. I mean, it always just comes back to that. There's never going to be a time when we shouldn't be doing that.
Yeah.
Right. So our job as an investing professional and helping, clients is helping them map those out. All right, where do we need to be on a risk profile, and then helping people actually effectuate, like actually walk through their plan and do what they're supposed to do. And if you can do that, right, that solves most all of the financial problems.
It feels like, Rex, that in summer 2026, we are sitting on a precipice that could be a phenomenal growth engine in the next 5 years that is maybe unprecedented because of AI and who knows, like geopolitical things going on, and we just keep growing and no bad things happen. And so everyone should be in the market, but you're very good at reminding us that bad things do happen, right? So
there it is. I think I just heard Brandyn say it's different this time.
Yeah.
So
you literally said this time it's different.
Yep.
I think he
that's
just
first red
said
flag.
that.
And
that's a red
but
flag.
The crazy thing is it could be. it could be like a longer period of growth than we've ever seen, but then it could be in this insane crash later.
Unprecedented is a huge word. I mean, not just the
not
fact
just
that it
word
has,
itself, but the meaning behind it.
Yeah, right. I mean, we've been through enormous runs before, right? You think about the run from the '87 crash, Black Monday, through 2000, 13 years, and you look at that entire tech buildup. And yes, it did hit a bubble and come down and things like that, and it took a couple years to recover from that. But boy, that was a big run during history. You look at the run leading up to the Great Depression, during the 20s, coming out of World War I. That was a huge run up during that time period. And so, I mean, there's a lot of periods in history where we've had some pretty massive runs. And so to sit there and say this is unprecedented is a pretty big statement. And I definitely am not in that camp. And so, I think most things go in cycles.
Yep.
I think, that the AI trade, if you will run a cycle. I have no idea how long that will be or if it gets into a bubble territory or are we already there. I have no idea. I can't predict that future. I do believe in being diversified. I do believe in controlling your personal risk of how aggressive or conservative you can handle so you don't make the exact wrong decision at the exact wrong time. Make the right decision for you, which is I can handle this kind of a downturn if it happens unexpectedly, because most downturns happen unexpectedly. And so make sure that you've got that risk so that you're not selling in a panic at the bottom just because you were unprepared or you didn't need the money or you didn't plan for your cash flows, right? Plan appropriately for your future.
Interesting. All right. So broader portfolio themes in summer 2026. Are we even talking about tariffs anymore and or like Bitcoin? Because I just don't hear those verbiages being thrown around much. And do they affect your positioning as an investor?
Yeah, I think they're definitely being talked about out there. I definitely hear people talking about Bitcoin and cryptocurrencies and the other kinds of coins and are they down? Are they going to recover? Is it still going to become a little more mainstream, things like that? We still hear those discussions. We're still hearing about it becoming more regulated and things like that, which we would still need in order for us to show any kind of interest in that. Do I feel like the the inflation and the economy and that's going to spur into we've had a couple of precious metals and things like that have had some big years, and if inflation picks up, you'll continue to have some of that kind of run. And so all these things are still being talked about. It's just most of them at the moment in average circles are being talked about with a negative tone and negative connotation, which is coming back to that consumer sentiment. And is it real or is it perceived? The future will tell, right? Who knows? But that's definitely the tone that's being talked about it right now in the public.
Brandon, you got anything?
Yeah, I agree with all of that, right? There's always fads. There's always things that get exciting but ultimately, right, you want a well-diversified, well-predictable, because what is risk? Right? And that's the question I ask clients all the time. What is risk? And there are certain things where risk is that I lose all of my money and it never comes back. Right? And that's there's actually a fairly significant possibility that happens. And that's significant risk. What is risk in the market? Could the market ever go away and go to zero and not come back? Yeah, it could. But what would that take? Right? That would take the companies of the world closing their doors saying we can't make money, right? That's Walmart saying, hey, we got to close our doors, right? There's all these companies that provide goods and services all go away and can't make money, right? And so as long as companies are able to make money, right, there's a value behind that. And that's what stock ownership is owning companies that are creating revenues, and then we participate in those revenues. And so, then what is risk? Because is there still risk in the stock market, even if you think that, corporations are going to stay? Yeah, there's risk. There's risk that, bad news comes out and everyone gets jittery and the stock price drops, right? But if it recovers, right, if we're diversified and we give it time to recover, then it's a lot more, that risk is a much different perception than risk of like a Bitcoin that could, just go away forever one day, without warning. And so there really is risk to everything, right? And the stock market is not risk free. And you absolutely can lose money, in the stock market, and it could go away, right? But when you look at probabilities and the likelihood of those probabilities, you can find a lot of peace in a very well diversified portfolio.
Yeah.
There's so many different kinds of risk. I mean, there's the risk of inflation pricing me out of my lifestyle.
Yeah.
Right.
Yeah.
If I can't have my portfolio or my money outpace or grow at least as fast as inflation is. Right now, inflation is about 4.2, something like that is about where inflation's running right now. It had just spiked up the last couple of weeks. And so, if you can't keep pace with that inflation, then eventually inflation's going to chew away at your buying power. And that means that, 10 years from now, you can't buy the same amount of milk that you're buying today. You can't, go on the same trips that, you're not going to be able to spend $150 on gas, on a tank of gas.
God, that was brutal.
Right? That was brutal.
Yeah.
And so, I mean, that's another risk is can you handle the risk of not having some of your portfolio invested in assets that have a chance or a possibility of keeping pace or outpacing inflation?
Yeah.
And I think everybody has to answer that for themselves.
I did learn, and I see why. It felt like half the cars on the freeways in California were Teslas, and I'm like, well, yeah, because my goodness, who wants to pay that much for that worked? And also, I did see, Rex, that, and this, I'm sure this was planned before the World Cup, but Buc-ee's is opening 15 more locations nationwide. Just so happens to coincide with the fact that the Europeans are over here for the World Cup, and they are also discovering Buc-ee's and giving it more pub and more love than Buc-ee's has ever had ever. But it's funny because that is and it is an example of how a global event, the World Cup, can impact a business personally.
Yeah, but they're spending a lot on advertising too, right? I can't tell you how frequently I'm seeing, something about Buc-ee's on my internet landing page.
Yeah.
Right. I think even just this morning, I think there was a quick blurb about Buc-ee's pay scales because they're hiring because they're growing so quickly, and so it's showing how much the different positions within there. Right. Front end manager gets paid this, cashier gets this, stocker gets paid this. And here's our benefits. Here's our 401k, and here's our match on our 401k, and I mean just right there on the landing page, right? And so I think they're
it's
doing a great marketing job,
Rex.
Yeah,
they're doing a great marketing job right now for sure. So
all right, anything else we missed on hot topics here in summer 2026 that you guys have got coming into your phone lines or your offices?
a lot of fires in Utah.
yeah.
Right now, talking about
location
hot.
days.
Yeah. Talking about hot. It's hot.
Yep.
No, I think this has been fun. I think it's fun to sit there and see what AI pulls up on occasions as far as hot topics in the market and in the community, and seeing what people are searching financially on the internet and talk about it. This has been a fun podcast. I appreciate it. Thank you.
If you found value in this podcast, which I know you did, you can consider supporting us financially at buymeacoffee.com/Banyan Media. And you can find us on YouTube as well at Through the Pines, where you can see our wonderful, beautiful faces. Like our Facebook page, Pines Podcast, and along with our Instagram, Pines_podcast. This has been Through the Pines, reminding you to use yesterday's dollars to finance tomorrow's dreams.